Hi everyone, welcome to this channel. If you're here for the first time, my name is Belin. I am a professional banker, and in this video we are going to be exploring an investment strategy that is called dollar cost averaging. I'm doing a series of videos on different investment strategies that you can adopt, whether you are new to investment or you are a seasoned investor. Of course, certainly you must have a strategy that works for you. So I'm running a series of different investment strategies that you can employ in your investment journey or in your journey to attain financial freedom. So if you're new to this channel, please press the subscribe button because you are in the right place. This is where you need to be. If you have been here before, thank you so much. And if you haven't subscribed, please press the subscribe button. Do give me a thumbs up and let's get started. In the video, we are going to be defining what dollar cost averaging strategy is, whether it works, we'll explore its advantages and its disadvantages. And at the end of the video, I'm going to take you through how to get started in your investment journey using the dollar cost averaging strategy. So please stay around. Now, what is dollar cost averaging strategy? What do you understand by the term dollar cost averaging strategy? In simple terms, this is the strategy where you set aside a specific amount of money to invest every so often, periodically. It can be weekly, it can be daily, it can be monthly, it can be quarterly, semi-annually, or annually. For instance, you can set aside a specific amount of money, say 1,000 shillings, to buy shares. Every month, you buy shares worth 1,000 shillings, regardless of the share prices, right? So dollar cost strategy is the strategy or the investment strategy where you set aside a specific sum of money, a specific amount of money that you periodically invest in a specific investment vehicle, regardless of the cost or regardless of the prices. So why would you want to use the dollar cost averaging strategy? What are the advantages? Or does it have any benefits to it? What benefits are attached to the dollar cost averaging strategy? First and foremost, by the mere virtue of the fact that you have spread out your investment throughout a period of time, it protects you from market volatility. Meaning that it protects you from the risk of buying shares, or let me paraphrase, it protects you from the risk of entering the market when the market is at its peak. In other words, it protects you from the risk of starting off your investment by buying shares, for instance, or ETFs, when the prices are at the highest. Remember, share prices fluctuate. Today, KCB shares are at 28 shillings. Tomorrow, they'll be at 38 shillings. So the dollar cost average strategy protects you from the possibility of buying even 1 million worth of shares when the share prices is at the highest. Remember, when you're transacting in shares, rather when you're investing in shares, you expect two types of gains. There's the capital gain, which is the gain or the benefit you earn from the fluctuation in share prices, and there's the dividends, right? So when you enter the market, when you buy shares, when the share prices are at the highest, for the same amount of money, if you are to buy Safaricom shares worth 100,000 shillings, when Safaricom shares are valued at 40 shillings, you will get less shares as opposed to buying Safaricom shares when the share prices is at 10 shillings. So the dollar cost averaging strategy protects you from market volatility. It protects you from entering the market when the market is at its peak. Those are two advantages of the dollar cost averaging strategy. Dollar cost average strategy also helps you to remain disciplined. Remember, you have set aside a specific amount of money that you need to be investing every month. So it keeps you in momentum. Every month, you know, regardless of the share price, you are going to buy shares worth 5,000 shillings. Regardless of the share prices, you are going to buy these specific shares worth 10,000 shillings, right? Now, what will be varying month on month, or what will be varying year on year or week on week, depending on your investment frequency, is the amount of shares that you'll be having. At one point, you'll be having 500 shares. At another point, you'll be having 300 shares or maybe 400 shares, depending on the share price on the actual date you'll be making your transaction. But at the back of your mind, you know that periodically, if you set it to be monthly, at the end of each month, as soon as you have received your salary, you buy shares worth a specific amount. What are the disadvantages? Does it have any disadvantages? Certainly, yes. I know of two disadvantages of dollar cost of this strategy. Number one, it is not foolproof in the sense that it will not protect you from a poorly performing stock. It does not protect you. It's not foolproof. It does not protect you from the share prices, the companies that are bound to underperform, right? There is also a potential missed gain. Dollar cost average strategy also predisposes you to a potential missed gain. And I'll illustrate that to you using this chart here. This is a table showing the historical prices for KCB shares. I've only taken for this year. And I would like us to see if you had 200,000 shillings in January, which will be a better option for you. Investing lump sum, buying KCB shares worth 200,000 shillings at once, or buying the shares monthly worth 20,000 shillings. Now the dollar cost averaging strategy. Have a look at this. In January this year, KCB shares was valued at 20.10 shillings. So if you are to buy, if you had 200,000 shillings and you opted to use the dollar cost averaging strategy to invest, meaning that every month you buy shares worth 20,000 shillings, I'm going to assume the brokerage fees and the investing charges in this particular example, yeah? So 20,000 shillings will give you 995 shares. So you can see in February you'll have gotten 952, in March you'll have gotten 634, and that comes down up to October, where the share prices closed at 38 shillings, and that would have given you 526 shares. So if you sum up the shares you'll have bought during the months of Jan, Feb, March, April, May, June, July, August, September, up to October 2024, you'll be having 6,775 shillings. And what will be the value of these shares as at 1st of November 2024? 67.75 times 38 will give you 257 for 50 shillings. Now, remember we said we had 200,000 shillings in January and we opted to use the dollar cost averaging strategy. So, if we had gone for the lump sum investment, if we had gone for the lump sum option, just buying the shares are worth 200k at once, as opposed to buying it in bits, where would we have been? The January share price was at 20.10 shillings. So 200,000 divided by 20.10 shillings, you have 9,950 shares, which would have been the shares amount, the quantity of shares we would have gotten in January had we opted to invest the entire 200,000 shillings that we had in January to use the entire 200k that we had in January to buy the shares, right? Now, because we opted to use the dollar cost averaging strategy, we now have shares worth, shares amounts of 6,775. And these shares are now valued at 257 for 50, being the current share price, yeah? As opposed to the value that we would have had of 378,109. Now you can see the share price for KCB has been on an upward trend. Now because the market, the KCB share price were on an upward trajectory, it is better to have bought those shares in January as a lump sum as opposed to buying them in tidbits. This is what I mean by you are likely to miss an opportunity, especially if the market is on an upward trajectory, right? So when then will it be advisable to use the dollar cost averaging strategy? Certainly when you don't have the lump sum amount of money to invest, you can only manage the tidbits. You can still use the dollar cost averaging strategy if you don't have the lump sum amount of money to invest. Yeah, so it's then an ideal investment strategy for guys who are young, 25 to 30, and you're just new in your investment journey, because you don't have the capacity to make lump sum investments. You can use the dollar cost average strategy to build up your wealth. So how would you get started in investing using the dollar cost average strategy? First and foremost, you need to identify the specific asset or the investment vehicle that you want to jump into using the dollar cost averaging strategy, the DCA, right? Now, once you have identified the specific investment vehicle or the specific assets, yeah, take for instance, you want to go into NSC, into shares, stocks, yeah, identify the specific stocks. And once you've identified, say for instance KCB, or you have identified Bamburi or whichever shares that is, or EABL, yeah, set aside a specific amount of money every month, and regardless of the price of this stock, regardless of how much these stocks will cost in the market on that specific day every month, if you're salaried for instance and you want to go into DCA, into dollar cost averaging strategy, you can set aside maybe 2K or 5K or 10K, so that at the end of each month, as soon as you receive your salary, regardless of where the prices of that stock is, you are going to buy it. You buy it, right? Now, the amount of shares, like I have said, will vary month on month depending on the share prices. So what do you think of this dollar cost average strategy, especially if you compare it to the previous strategy, the 3-bucket rule strategy? In my case, I think I use them hand in hand. I'm using the dollar cost strategy to complement my 3-bucket rule strategy, because in my 3-bucket rule strategy, I also have shares as part of my portfolio, and I don't have the lump sum amount of money to buy shares all at once. So what I do at the end of each month, I have set aside 5,000 shillings that I buy shares with. And the share that I buy, though I have gone deeper now, I have picked 5 counters. Don't ask me which one they are. I'm not going to share that. Speak to your stockbroker. But I have identified 5 counters that I keep growing every month. Now, to wrap it up, dollar cost average strategy is a good investment strategy that you can use if, one, you don't have the lump sum amount to invest in, if you lack the experience or the skills to monitor the markets or to time the markets, right? And no timing the market means that waiting for the share prices to come down so that you can buy low, waiting for them to increase so that you can sell. So if you don't have the skills to time the market, dollar cost average strategy is a good strategy for you to adapt for long-term wealth growth. Finally, please press the subscribe button and see you on the next video as we discuss the next investment strategy.